I'm Jeff Zimmerman, CEO of Fortin Home, and welcome back to Builder's View. Today we're breaking down one of the most important and most misunderstood concepts of real estate investing, private equity. Most people understand owning rental homes or buying stocks, but private equity is different. It's more strategic, more structured, and when used correctly, it's one of the most powerful tools for creating long-term real estate wealth. In this episode, I'm going to explain what private equity actually is, how it works inside a real estate deal, how equity partners get paid, why equity sits at the bottom of the capital stack, and how private equity helps build real estate projects, including attainable housing. This is an educational episode, not a pitch, not an offer, just clarity, so you can make better decisions. At the simplest level, private equity is ownership. You contribute capital. In exchange, you receive an ownership interest in a specific real estate project or operating company. You're not a lender, you're not collecting monthly rents, you are an owner, participating in the ups and downs in the investment. Private equity typically includes a percentage of ownership in the project, a share of the cash flow, a share of the profits at sale or refinance, a defined structure for how and when you get paid back, and unlike public stocks, private equity is negotiated privately between investors and operators. Think of it as you own a piece of the building and you benefit when the building performs. In most real estate deals, private equity fills a portion not covered by debt. Here's the basic structure of the capital stack. Senior debt, usually a bank loan. Mezzanine debt, sometimes used. Preferred equity, optional tier, and common equity, the owners. Private equity lives at the bottom. That means equity gets paid back after all the debt is paid. The trade-off is clear. More risk, more upside. Banks make their 6 to 8% interest, then equity earns whatever remains, sometimes 12%, 20%, or 30% plus, depending on the project and the market. Equity is the entrepreneurial part of the deal. Private equity earns returns from three main sources. Number one is cash flow, income from rents, operations, after expenses and loan payments. Two is forced appreciation, value created through construction, improvements, or repositioning. And then three is exit profits, proceeds from a sale or refinance distributed according to the operating agreement. Unlike lenders, equity investors are not paid on a fixed schedule. Returns are tied to the performance of the project. Well-structured deals define exactly how profits are split, what the preferred return is, if any, how capital is restructured, when distributions begin, and what happens at the exit. This clarity is critical in institutional real estate. Now let's talk risk. In a real estate capital stack, debt gets paid first. Equity gets paid last. Here's the order of repayment if something goes wrong. Number one is senior debt. Then number two is mezzanine debt. Then three is preferred equity. And last is common equity. Equity absorbs the first losses, but also captures the largest upsides. This positioning is why many investors blend private equity with private debt. One provides upside, the other provides contractual payments. Together, they create a balanced risk-return profile. Most real estate private equity follows the GP-LP model. GP, which is the general partner, finds the deal, arranges the financing, manages the construction and operations, signs on the loan, executes the business plan. And the LP, which is the limited partner, they contribute the capital, receive preferred returns and profit splits, and do not manage day-to-day operations. It's a partnership. The GP provides expertise and execution, and the LP provides capital. And both share in the eventual success of the project. This model is the backbone of institutional real estate across the country. Private equity is often the first domino that makes the project possible. Equity funds, land acquisition, early architectural and engineering, entitlements, pre-construction, deposits for material and manufacturing, and the equity required by the bank to close on the loan. Debt will not fund a project until equity is in place. Equity is the foundation that everything else sits on. In attainable housing, private equity is what allows faster starts, creative capital structures, off-site production, community development. Private equity is not abstract. It becomes roofs, walls, streets, and real homes for real families. Private equity plays a clear role in a diversified portfolio. Investors choose private equity for higher potential returns, inflation protection, ownership in real assets, partnership with experienced operators, long-term compounding, and appreciation plus cash flow. But it comes with considerations. long time horizons, less liquidity, project-based risk, performance variance, and dependency on operator execution. For investors who want to build long-term wealth, private equity can be a meaningful component, when sized correctly and understood clearly. Before allocating to private equity, ask yourself, what is my time horizon? Do I understand the business plan? How strong is the operator's track record? What are the exit scenarios? How are profits shared? What risks could impact the returns? Does the project align with my values and goals? These are the questions thoughtful investors ask. There are no guarantees, only disciplined decision-making. Private equity is not new. It's the backbone of real estate development in every major city in America. In this episode, we covered what private equity actually is, how equity works inside a real estate deal, why equity sits at the bottom of the capital stack, how GP-LP structures split responsibility, and how private equity brings real housing projects to life. If you want deeper educational resources, you can visit fortinhome.com. And if you want to learn more about private debt, you can watch our past videos. This video is for educational purposes only. It is not an offer to sell or a solicitation to buy any securities. I'm Jeff Zimmerman. This is Builder's View, where we break down how real estate actually works so you can make informed decisions.